Good afternoon, and thanks for joining us for today's webinar, SOX. Are you still testing too many controls? I'm Elaine, Nissley, Director of McKonly Asbury, and joining me today is Senior Manager Victor Kong. I've been with the firm for 20 years. This is my 20-year anniversary. Throughout that time, I've led the internal audit practice, doing quite a bit of Sarbanes-Oxley work and NIST 853 IT security, cybersecurity, and I've recently taken on leadership of the CMMC practice as well. Victor, would you like to introduce yourself as well?
Yeah, sure. Like Elaine said, my name is Victor Kong. I'm the Senior Manager for the Internal Audit practice here at McKonly. I have 18 plus years of internal audit experience from different industries. And here at McKonly, I lead the internal audit and SOX projects. And I'm also a qualified EQA assessor. Back to you, Elaine.
Okay. Thank you, Victor. If you're not familiar with us, McKonly Asbury is an accounting and business advisory firm, and we have offices in Camp Hill, Lancaster, Bloomsburg, and Philadelphia, Pennsylvania. We also provide national services in our cybersecurity and SOC practice. We offer a wide range of services to organizations in various industries. For more information, please feel free to visit our website. If you've joined us on past webinars, welcome back. If you haven't, our monthly webinars feature various business topics to keep you updated on what's going on around us today. Be sure to check out our website to catch past presentations as well as current information through our blogs. Next, we're going to have a polling question. As you know, responding to polling questions are a requirement in order to get your CPE credit for the webinar. And the first question is, do you wish to receive CPE for attending today's webinar?
Our first polling question has been launched. Please take a moment to select your response and then click the submit button. We'll hold the polling question open for a few more seconds. Thank you for your responses. We'll be closing the poll now and displaying the results. Thank you, everyone. We'll now continue.
Our objectives today are to explore the number of controls needed to comply with Sarbanes-Oxley. There's been a great change over the years from 2004 to present, and really the emphasis in the area of Sarbanes-Oxley is a risk-based approach to internal controls, helping to reduce the burden on organizations. So we're going to look at control rationalization. And another area we'll explore today is IT general controls. They're a critical component of internal controls over financial reporting and a little known area generally in the Sarbanes-Oxley field. And now on to polling question number 2. What is your organization's status of Sarbanes-Oxley implementation? Are you not required to implement Sarbanes-Oxley? Are you considering implementation? Is your implementation in process? Are you looking to improve and streamline your implementation? Or are you happy with your Sarbanes-Oxley implementation?
And we are now launching our second polling question. Please take a moment to select your response and click the submit button. And we'll hold the poll open for about 45 seconds. Thank you for your incoming responses. We'll hold the poll open for a few more moments. Thank you, everyone. Closing the poll now. And let's display those results. And we'll close the poll now and move on with our presentation.
So I know a question in the Sarbanes-Oxley arena for years has been, how many controls are enough? What's going to help us provide reasonable assurance that the financial statements do not have any material misstatements? And so we're going to talk today a little bit about the risk-based approach and the number of controls that are typically found within here. So we're going to talk about Sarbanes-Oxley and internal controls over financial reporting. We'll discuss the average number of controls based upon our current study, the types and categories of controls, the effectiveness of the controls, some of the control challenges, and look at a risk-based approach and the associated best practices. Sarbanes-Oxley, as most of you probably already know, was established in 2002 in response to corporate scandals such as Enron, WorldCom, and locally Tyco was a part of that as well. And it was implemented to protect investors and ensure there were accurate financial reporting. Section 404 of the Sarbanes-Oxley Act of 2002 specifically speaks to management's assessment and reporting on the effectiveness of internal controls over financial reporting. Section 404 requires companies to maintain an effective system of internal controls over financial reporting, and it also requires the external auditors to assess the evaluation of the internal controls and look at whether or not management's attestation for the effectiveness of internal controls is accurate. So internal controls over financial reporting, as we mentioned, they provide reasonable assurance that the financial reports are accurate. There's integrity within the financial reporting process. The assets within the organization are safeguarded, and the organization is in compliance with the regulatory requirements, especially Sarbanes-Oxley requirements. The effective internal controls also helps to protect the financial statements from errors, fraud, and misstatements. So typically when you're looking at internal controls, there's usually an awareness for fraud and a fraud component associated with a lot of the controls. The objectives of ICFR are to provide reasonable assurance of accuracy and completeness, verify there's timely preparation and submission of the financial reports, and utilizing preventive and detective controls to identify and mitigate any risks throughout the financial reporting process. So what is the average number of internal controls for financial reporting? There's no set number. There's not a magic number, and it varies anywhere from 100 to 300 controls, depending upon the complexity and decentralization of the organization. Another factor that relates to the number of controls that you want to include in your Sarbanes-Oxley testing is the maturity of the governance environment. In other words, are there good business ethics? Are there practices throughout the organization that would result in employees that are ethical and knowledgeable in their positions? So again, governance and the control environment is a critical component of the assessment of the controls, and in a risk-based approach, you really start at the top and make sure you have good governance controls, and then apply that reliance on the fact that you have knowledgeable individuals that have an ethical basis and have adequate staffing to perform the controls. So that can really help you place more reliance on your review and your higher level controls versus your day-to-day controls that are much more time consuming to test. Categories of controls in the internal control framework that's typically used by organizations are, you have entity level controls and then you have process level controls. So the entity level controls are controls that are in place across the entire organization. And usually they're human resources related. They talk about tone at the top, board oversight, the training that occurs throughout the organization, the awareness of acceptable business conduct and ethical procedures. All of those are pervasive and cover the entire organization. The other types of controls you have are process level controls. So you need to look at what material processes are involved in the financial reporting process, and you include processing controls such as accounts payable, your month-end close, receivables, and then you also get into IT controls, which we'll talk about a little bit later. There's also within the IT general controls, you have system-related controls, which are application controls that can help provide accuracy and validity of the information that's entered. And you also have the controls over access to data. You have data backup controls, which will give you assurance that even if the data is lost, you can get it back and still prepare your financial reports. You have system development and change management controls, which are very critical so that you can make sure that the IT systems that you're relying on are providing the results that you're looking for and that those results are accurate. Another key component of controls is third-party vendor controls. And a lot of organizations deal with that by obtaining a SOC 1 report, Service Organization Controls Report, which covers controls that a third party has in place over the financial reporting aspects. And a SOC 2 is, for example, if you're outsourcing your data center, you would do a SOC 2 type 2 report over the security controls, possibly processing availability, but again, addressing the IT controls at your third-party vendor. An important component of the testing is not just making sure the controls are there, but that the controls are working effectively, working the way management believes those controls are working. And here's where an independent party, typically like an internal audit department, will come alongside management and assess the effectiveness and the operation of the controls. There's also the external auditors that will then come behind whoever did the testing for management of those controls, and they'll review the testing that was done, do some of their own testing, and validate that the controls, again, are operating the way they're reported to be operating. Some key consideration for the effectiveness of the control is to make sure that they're documented and that there is evidence of the control. Doing a review of a reconciliation without signing and dating that the review was completed will not provide the evidence that you need. So just performing the control without leaving some sort of evidence behind that's available to the auditors will result in an assessment that the control is not operating. There's regular monitoring and testing of the controls, and again, frequently internal audit will do testing, but it behooves management to also monitor the controls and what's happening within their area of responsibility. An important thing when you're doing the Sarbanes-Oxley, the opinion is on how the controls are operating at the end of the period. So it's important to get in early, do some preliminary testing, and if there are some issues that have developed since the last time, maybe you've had staff turnover or some other issues have occurred throughout the system. If you test early and identify those issues, then you have the opportunity to remediate the controls, and they can still end up operating effectively at the end of the period. Now, some of the common control challenges that organizations face are weak segregation of duties, especially in smaller organizations. It can be difficult to actually segregate all of the functions. And then when that happens, you need to just make sure that there's enough review that people are not reviewing their own work. Another challenge is, again, the lack of documentation, and without documented evidence, it's very difficult to prove that a control operated. Another challenge is some organizations are dealing with very outdated IT systems, and they may have limited automated controls that you can rely on, and therefore you need more manual controls. Or that you can have an IT area that just does not understand the importance of internal controls, and they have a weak systems of internal controls over IT. So the impact of the control weaknesses, regardless of where they happen throughout the system of financial reporting or whether they happen as an IT general control, they can result in the requirement to restate the financials. You can lose investor confidence in the organization, and they can result in regulatory penalties, fines, and jail time. So again, having a good system of internal controls without any kind of significant or material failures is very important for organizations. We talked before about using a risk-based approach. And I had mentioned you first look at the control environment, at the governance controls, and strong controls in the area of governance can really reduce the need to test your detailed controls. And it can also obtain reasonable assurance when you test and review governance controls. Always assessing the tone at the top. Interviews with senior management with the board can be very helpful in assessing that tone. If the control environment is weak, it will reduce management's reliance on daily and weekly controls and increase the number of controls included in the testing population. So Sarbanes-Oxley requires companies to implement a robust system of internal controls to ensure the accuracy of the financial reporting. The number of controls varies by company size, complexity, and risk profile, but typically ranges from 100 to 300 individual controls. So effective implementation and regular testing of these controls is critical to achieving compliance and maintaining trust with investors and regulators. And now we've reached the end of this section, and polling question number 3. Which best practices do you think will add the most value to internal control over financial reporting within your organization?
And we are now launching our third polling question. Please take a moment to select your answer and click the submit button. And we'll hold the poll open for a few more moments. Just a reminder, if you have any questions for us during today's presentation, please submit them through the questions function in the webinar control panel. We'll do our best to answer them during or after the webinar. And we'll hold the poll open for about 10 more seconds. Thank you for your responses, everyone, and it is now time to display the results. Thank you. Closing the poll.
Thank you, Elaine. In this session of the webinar, we will be discussing SOX control rationalization, a process to streamline SOX compliance and improve efficiency in managing SOX control. We will focus on how organizations can ensure compliance with SOX while reducing costs and complexity. So here is the agenda for the next few minutes. We will start with exploring the concept of SOX control rationalization. We will then discuss the objective, benefits, challenges, and the key steps in the process. And finally, we will look at tools and techniques for control rationalization. And then, we summarize, with some key takeaway. SOX control rationalization involves evaluating and optimizing control to eliminate redundancy and inefficiency. The goal is to focus on control that provide the most value while ensuring compliance. For example, if you have two manual review process that can be consolidated into one single automated control, so this control rationalization will help you do that. So why rationalize controls? Without rationalization, organizations often face overlapping controls that lead to inefficiency and unnecessary costs. Also, organizations may have too many low-impact controls, and that can lead to excessive control testing, which diverts resources from critical risk area and create compliance fatigue. So in short, SOX control rationalization helps eliminate inefficiency, allow organizations to focus on high priority risks and reduce compliance costs. The main objective of control rationalizations are to reduce redundancy, streamline processes, and focus on high-value control. By doing so, organizations can achieve cost efficiency, simplify SOX compliant processes, and allow organizations to direct resources toward critical risk area and ensure that they are compliant with SOX. Okay, what are the benefits? The benefits include significant cost reduction in control testing and auditing. It streamlines control environment, which can lead to better resource allocation and improved processes. This can help businesses to run more smoothly without sacrificing compliance. Another benefit is that it will allow organizations to better focus on critical risks and allocate resources to the area that matter the most. By optimizing control, organizations can ensure they remain in full compliance with SOX requirement while avoiding overcomplicating the control environment. So the overall impact is more efficient control environment and effective compliance process. Okay, the process is not without its challenges. Resistance to change can arise from process owners who are accustomed to existing processes. Aligning with stakeholders such as internal and external auditor can always be a challenge. And there is always a risk of oversimplifying and unintentionally removing critical control in the process. At a high level, the rationalization process can be broken down into 7 steps, starting with inventorying existing control, followed by assessing risk, evaluating control effectiveness, and prioritizing key controls. Also, standardization and automation, stakeholder consultation, and thorough documentation are also critical components. The first step is to catalog all controls and identify redundancies and overlaps. This involves creating a comprehensive control inventory to serve as a basis for rationalization. The next step is to map controls to the risks they address and assess their financial impact. A risk heat map can be used to prioritize high-risk area while identifying control tied to low-risk activity. These steps is to ensure that we focus on control that matter the most to financial reporting. Step 3 is to evaluate control effectiveness. Evaluate and assess each control effectiveness by determining whether it achieves its intended purpose. Also here you identify, consolidate, and eliminate ineffective and redundant control if you find any. Step 4, prioritize key controls. Once effectiveness is evaluated, prioritize control that address significant financial risks. So low priority controls can be de-emphasized or removed so that we don't waste resources on those controls. This is where risk-based approach is essential to identify critical controls. Step 5, standardize and automate. Standardization and automation to simplify processes and reduce human error. Repetitive tasks like account reconciliation or approvals can be automated using software. This reduces cost and frees up resources for other more important activities. Step 6, consult stakeholders. To be successful in this process, it is always important to engage all relevant stakeholders, such as internal, external auditors, compliance teams, and management to ensure everyone is on board with the changes. Collaboration with stakeholders to address some of the concerns and ensure everyone is on the same page. And finally, document all changes, including the rationale for removing or modifying controls. Provide the updated risk and control matrices to auditors as evidence of the rationalization process. Clear documentation ensure transparency and support SOX compliance. There are tools and techniques out there that an organization can use for control rationalization. Organization can leverage tools like risk and control matrices, process mapping software, and GRC platform for control rationalization. Techniques like risk-based testing, data analytics help identify areas for improvement. These tools ensure that we have a systematic, data-driven approach to control rationalization. To summarize, SOX control rationalization improves efficiency, reduces cost, and strengthens compliance efforts. A risk-based systematic approach ensures success while maintaining SOX compliance. Back to you, Elaine.
So now we've come to polling question number 4, and the question is, does your organization test the right number of SOX internal controls over financial reporting? In your opinion, does your organization test too many, test the right amount, do not test enough, or this does not apply to your organization?
And we are launching our 4th and final polling question. Please take a moment to select your response and click the submit button. And we'll hold the poll open for about 45 seconds. Thank you for your responses, everyone. We'll hold the poll open for about 5 more seconds. Please be sure to click that submit button. Okay, closing the poll now and displaying the results. Thank you. Let's move on with our presentation.
Okay, now we're getting into the final segment of our presentation. We're going to talk about IT general controls and internal control over financial reporting. And the question is, how much is too much? Okay. So the objectives of this portion of the presentation is to understand why IT general controls are important for internal control over financial reporting. We'll look at an ITGC risk assessment and scoping process. We'll discuss some of the core ITGCs that are important for financial reporting and look at some future trends within IT general controls. There was a study completed by IdeaGen Audit Analytics, and this is a relatively recent study. It covered the period from 2004 to 2022. And I have statistics up here from 2022. And they talked about information technology general controls and how they provide assurance over the accuracy, reliability, completeness, security, confidentiality of the financial reporting, and how the failure to remediate ITGC's issues timely can really result in larger impacts. So when they talked with auditors, they asked what had the most adverse effect on the financial statements, which component of internal controls over financial reporting. And 54% indicated that the top one was information technology controls. Number 2 at 53.7 was accounting personnel resources. And this again gets back to your entity level controls, your general controls. Are you hiring the right people, providing training, looking to make sure that they have an understanding of the ethics within the organization. And the third item at 39.7% was inadequate disclosure controls, followed by segregation of duties and non-routine transactions. So as this study showed, information technology general controls, it has a huge impact on your financial reports and the reliability and integrity of those financial reports. So what types of weaknesses are found within IT general controls? One of the areas frequently found is lack of segregation of duties and excess user privileges. So you may segregate duties within manual processes, but people don't always take that segregation into the applications and the systems that are being used. And so even though an individual, according to their job description, may not be able to approve a journal entry as well as preparing the journal entry, if the system allows them to prepare the journal entry and then turn around and approve it, then their lack of segregation of duties exists, even though their job description says that it does exist. Another area of concern are weak passwords and monitoring of what users are doing. And one of these areas frequently applies to IT itself, and that is, are you allowing your developers that are making changes to your important financial applications, are you allowing them to make those changes and also move those changes into production? And if you are, because you're a small organization, are you monitoring what's happening? Another area of concern is delayed removal of access. Is HR being notified timely? And is Human Resources notifying IT to remove the access when the employee leaves the organization? Again, if it's on good terms, it may not be an issue, but if there was any kind of dissatisfaction with the organization, it can be a great risk for individuals to have access after their last day of employment. Inadequate change in management. We did talk a little bit about the lack of segregation between development and production access, but there's also been a change from what we call the waterfall, the slow, deliberate process for implementation of system changes, and the current agile, hurry up and get it done changes. And so again, even though you might be doing only 6-week sprints and getting items into production, you still should be following the segregation of duties and doing adequate testing of those changes before they go into production. Another big area is lack of business user involvement. The business users understand their requirements, they understand their objectives, and any changes that happen to their systems, they should insist on being involved and not abdicate the responsibility to IT. IT has a governance framework as well as the overall environmental entity governance. And so there's some specific requirements within the IT governance and oversight. If there isn't adequate governance and oversight within IT, there can be lack of accountability, unclear responsibilities, and insufficient management oversight of the IT controls. So this can result in lack of documented policies and procedures, inadequate management review of what's happening and the approval processes within the organization. And it can also result in a failure to remediate internal control deficiencies that are discovered. IT, of course, is always in a rush to implement the latest technological advances, and they can sometimes put on the back burner the thought of the internal controls that need to go along with those advancements. So using the latest technology is important. It's not always the number one priority. The number one priority for IT should always be accuracy, reliability, and security of financial information and the information coming out of all of their systems. There can also be a lack of awareness and training within IT. It can result in employees failing to properly prioritize IT control implementation and understand their responsibilities and the importance of compliance with the IT general control requirements. There can be an inadequate communication of changes, failure to provide ongoing IT control awareness training can also have a negative impact on financial reporting. It's easy for operations management to step back and let IT take the lead on system changes and abdicate their responsibilities to making sure that those systems changes actually comply with the business requirements. So there really needs to be a strong relationship between business and IT and a respect on both sides for what each side brings to the table. The business side being the understanding of the business strategic direction and requirements, and the IT, the understanding of technology and how that can support the business and lead them into the future. The importance of identifying the relevant systems that actually impact the financial statements cannot be understated. And when you're looking to identify significant systems, that's not just the systems that are maintained in-house and on premises. The system can be in the cloud, it can be a third-party system. And just because there's this third party doing the processing does not relieve you of the responsibility to make sure that that third party has the appropriate IT general controls in place. And then if that third party is using a subservient organization, another organization for critical components and holding some of your critical data, then it's important that you also look at the controls of that third party. I'm somewhat of a proponent of saying, yeah, I think you really should go down to the nth level because it could be 5 vendors removed where your security breach could occur or the inaccuracies in your financial statements could be generated. But in reality, going to the nth level is not really realistic. And so typically, if you look at the SOC 1 or SOC 2 reports for their third-party organizations and any organization for which they rely on it. Because if a third party is relying on another party, the SOC 1 or SOC 2 report that you're reviewing will not be valid unless those organizations have adequate controls in place. So again, not only obtaining the SOC 1 and SOC 2 reports from third parties, but also understanding how to review those reports. And if there's any user responsibilities for your organization, make sure you're doing what you're required to do to support the controls for those third-party organizations. If you're going to look at your IT general controls, you want to do it in a risk-based approach. And therefore, you need to perform a risk assessment and look at your scope. You need to identify the financial reporting systems that are dependent upon IT. And these could include your enterprise system, your financial databases, or as we discussed previously, the external systems. And you need to consider the materiality and criticality of these systems. So if you have a system that's processing information and maybe it's even less than 1% of your bottom line, you probably don't want to spend your resources there. It's the ones that will actually have a material impact on your systems. So you need to evaluate the IT general controls areas based on the risk that they pose. Again, IT governance is a pervasive control, and that's very important in the reliability of your IT controls. Another area of importance is access controls. You know, how the access is granted, modified, and terminated. Change management, again, making sure that the only changes going into your applications are the changes that are approved by the business side. Are there adequate backup and recovery processes in place to make sure that you can continue to have the financial data that you want? Systems development is another area. Again, what IT is working on should be prioritized and driven by the business side, what will further their objectives and meet their requirements. There should be a regular review and update of the IT general controls. I mean, technology is changing rapidly, and not only should you make sure that your controls are up to date, but you should look at the processes that are being automated and where can you take advantage of an automated control and reduce your manual processes. Because again, an automated control is much more reliable than a manual control. Some of the challenges you face when performing your risk assessment is if you're dealing with large, complex IT landscapes, it can be difficult to ensure that all the relevant systems and processes are looked at and assessed properly. You have emergent cybersecurity risks that need to be dealt with, and they can pose significant financial risks to your financial data and the integrity of that data. SOX and other regulatory changes continue to evolve, and they can affect the scope and the nature of the IT general controls. And then we did spend quite a bit of time on the integration of the third-party systems and the use of third-party systems, which can never be ignored in your risk assessments. Okay, when you're looking at the critical systems, we need to look at the materiality of the systems. How critical are they? Can the function be replicated manually, or is it critical in order to produce your financial statements? And again, are there both internal and external dependencies? There's core IT general controls that should always be considered when you're going through and assessing the ITGC. User controls, you need to look at how the users are authorized. You need to make sure that when you are providing access, take into consideration segregation of duties, and not just within the applications itself, it can be within the maintenance and updates to the supporting infrastructure. And then, of course, authentication controls. Strong passwords is not enough anymore. We need multi-factor authentication with at least one or two other methods of authenticating who you are. Change management. We talked about the need for authorization, attesting, and documentation of the changes. But we should also make sure we have adequate audit trails so we know what changes occurred and who made those changes. And when those changes are occurring, are they in compliance with the internal control of financial reporting requirements that you have? Data backup and recovery, system monitoring and logging, and incident management. Again, when it comes to all the cybersecurity threats that we have, monitoring your boundaries and managing any incidents that occur are critical. So some of the future trends in ITGC is there's programs out there now that can automatically monitor your IT general controls and alert on anomalies. The same thing in the cybersecurity arena. They're getting to the point of being able to use AI to identify false positives and reduce the amount of work that's required in order to verify that your boundaries are not being breached. Cloud computing can provide centralized processing with very strong cybersecurity controls. And of course, continuous monitoring of the environment is always important. Bill Gates said in 1999, and hasn't changed in 25 years, information technology and business are becoming inextricably interwoven. I don't think anybody can talk meaningfully about one without talking about the other. Questions? Okay, so then if we don't have any questions, and I don't think anything came in through the chat, then we will go into our closing today. We want to thank you for joining us for today's webinar. If you have any further questions regarding today's presentation, please feel free to reach out and our team would be happy to assist. The recording of today's presentation is going to be posted on our website and our social media sites in a few days. So for those of you who requested CPE and answered the polling questions, those certificates will be sent out within the next month. And we do here at M&A have some additional upcoming events. On March 27th, we have a free webinar. The registration is open for the business valuation webinar, and this webinar will provide attendees with an understanding of the key components of the Tax Cuts and Jobs Act, as well as examples of valuation and tax implications of a sunset or extension of the Act. Thank you again for joining us today, and I hope you enjoy the rest of your day.